In this video and Jupyter Notebook, we're going to walk through how to trade option implied volatility. I've broken it down into three key components, the first being understanding what volatility even is, different measures of volatility, and how we might be able to develop an aggregate measure of volatility using all of these different ways to represent this notion of dispersion. The second being understanding the impact of volatility on an options price, and the third being developing some sort of statistical basis for your trading. Now, it's very important to keep in mind that whenever you develop a trading model, one thing is certain, and that one thing is that your model is incorrect. But hopefully you've seen some of my other videos on how to trade, or maybe that the expectation doesn't exist, and you're starting to see that even though our model is incorrect, it does not mean that we cannot profit from it. Let's start with this idea of what volatility even is. Volatility is this notion of quadratic variation on the return series. All that really means is we're looking at the statistical variance or the standard deviation to come up with some sort of measure of dispersion of those returns. Now, hopefully you've seen some of my other videos on how to trade, or that the expected return of a stock doesn't exist, because when we use this measure, it's already wrong. What I mean is we're relying on this mean return to develop a notion of distance from return. That's what dispersion is in a statistical sense. But that mean return doesn't converge to one value. So what might be an outlier in one period might be very common in another. There are several reasons why this is the case. One being that this return distribution just changes over time. If that's confusing, just think about a company in the early 2000s and in 2025, 25 years later. Clearly, that company is going to be a completely different company. Macro regimes don't just change, administrative regimes don't just change, but even within that company, leadership changes. So there are a lot of different factors that contribute to this measure of volatility being wrong in general. Moreover, this true volatility process that we're trying to measure is always going to be backwards looking, right? We need the return to develop this measure. So the volatility itself is not actually observable, at least in this sort of backward looking sense here. Some firms have proprietary measures and this or that, but quadratic variation and variance is a very, very simple way that is typically highly correlated with these very proprietary measures of volatility. Knowing that volatility is this difficult to measure unobservable quantity, how can we go about modeling what the value actually is? Well, there's a couple of different things we can do, and the first thing we can do is develop a simplified state of the world where volatility is constant. Then we can impose this structure of a standard deviation on the historic returns, so the returns that we've already realized, and see what the standard deviation is of those returns relative to some true measure of volatility that was used to generate that process. What do I mean by this? Well, here I have a nice looking chart that simulates a stock price, and it simulates a stock price based on a constant volatility of 0.2 or 20%. So what I've done here is I've imposed that structure of a 30-day rolling quadratic variation, and I've annualized that value by just multiplying by the square root of 252, but we won't get into the details right now. The important thing to know is volatility here. We know what that true value is. In real life, we don't know what the true volatility value is generating that price process. However, here we do. So we can see essentially how that standard deviation does at coming up with a number, pretty much coming up with a number out of thin air, because again, that volatility value is non-observable. We can't actually see what it is. So what we're going to do here is we're going to impose this 30-day rolling quadratic variation, and we could see, okay, on a rolling basis, we get somewhere between 0.1 and 0.2. Certainly better than nothing, because we don't know if it's going to be close to 0.01 or if it's going to be close to 1.2. We have no idea where that vol might actually reside. Here we know it's 0.2, and imposing this structure of a 30-day rolling quadratic variation, we see that it's between 0.1 and 0.2, certainly better than nothing, may be a reasonable measure for what the true volatility of the underlying process is. I say that it is not bad. There are certainly things we could do to improve this, but at a cursory level, this is definitely a reasonable way about going about measuring historic realized volatility. Now, of course, in this example, volatility is constant. This is not the case in real life. Volatility itself is a stochastic process. So let's increase the complexity of that simulation. It's all about starting with a base case and increasing complexity, because if you can't profit in a pretend world where everything is simple, how on earth are you going to profit in the real world where everything is incredibly complex? Here, volatility is not constant. Volatility is a stochastic process. It's a mean reverting process. This is a Heston model, which assumes an Ornstein-Uhlenbach mean reverting process for the volatility path. What we have here is this blue path is the stock price. This green path is the true volatility path. This is starting to look more like real life. Volatility is not a constant 0.2. It's not a constant 20% like in this simplified example here. Volatility is now a stochastic process. So when we impose this 30-day rolling quadratic variation, you can see this red line is trying to track this green line. And though it is incorrect, it's incorrect probably all of the time, it is certainly better than nothing at discerning a level of volatility. Now, of course, it's lagged, it's backwards looking, all of these things. However, remember, this is a random variable that evolves over time. This is a very simple measure. We're taking the standard deviation of the previous 30 days of returns. A very simple rolling measure is trying to capture the dynamics of this very complicated, unobservable process. So it's certainly doing a relatively reasonable job. Of course, there's going to be issues with it. It's backwards looking in that sense, so it's always going to be delayed and this and that. However, in terms of trying to discern a level, it's doing a pretty good job, because this red path is relatively in line with this green path. When I say it's better than nothing, it's certainly better than nothing, and moreover, it evolves with time. So remember, in real life, volatility is not going to be constant. It's going to evolve over time randomly. And here we can see this red line is doing its best at tracking this true vol measure. So again, we won't see this green path in real life. We'll only have this red path, and it's certainly doing a reasonable job. This is definitely not a model that I would use in real life. This is a very simplified, again, simplified example, simplified model. But what we're trying to do here is we're trying to understand why volatility is difficult to model. And that's due mainly to the fact that it's unobservable and evolving randomly through time. So here, 30-day rolling quadratic variation on a volatility price path that is more reflective of something that you would see in the real market. It does a reasonable job. In the context of modeling volatility, we face several challenges. I've discussed a few of them, and I've listed some of them here. But there's a lot we can do to try to develop a better model than just this simple rolling 30-day average. And there's a lot of different models for volatility. And in fact, each one probably merits a lecture for each model. Nevertheless, I figured I would discuss the different tasks from time series analysis and some of the models for volatility, so that if anyone wanted to continue doing some research, they certainly could. So in terms of time series analysis tasks, remember, if volatility is a random process that evolves over time, this is going to be relevant to the entire study of time series. So there are three tasks essentially that you can do in a time series setting. You can filter, smooth, or forecast. And all that really means, and I've broken it down here, is filtering is where the heck is vol at now? So what is the reasonable level of volatility now? That's what we try to accomplish with filtering. Smoothing is where the heck was vol. So in a backwards looking setting, where the heck was volatility at this time. Of course, this is in the backwards looking setting. And then, of course, forecasting. Where the heck will vol be? All of these are very relevant. If you have any hope to forecasting vol, you should sure as heck know where it was and where it is now, right? That seems a very, very important and necessary component of forecasting is smoothing and filtering. But that is something that I will leave to further study, and perhaps these are lectures again of their own, because these are certainly some very important topics. I figured I'd also list some volatility models here. We have arch-garch models. Of course, a garch model is going to be a more parsimonious representation of a higher order arch model. We have some sort of mean reverting process, as I've visualized earlier in a Heston setting, and then you can do some sort of exponentially weighted moving average, which this may have been redundant to list, but regardless, I figured I would include it in the volatility models section. So in the context of modeling volatility, the keys are that, again, volatility is unobservable, and these statistical measures change over time, and we're always going to be trying to figure out where the heck volatility was, where is it now, and where it will be. Knowing now that there are several models for volatility and there are a variety of different tasks related to this volatility measurement process, I was just going to include another simple example of a different measure for volatility. That is, we have this Heston price path, we have this true volatility path, and now I've included a new measure of volatility. I have this 30-day rolling quadratic variation, and I also have a 15-day rolling quadratic variation. Which one is correct? And that's exactly my point. So here we have two different measures of volatility objectively in a backwards looking setting. Which one is more correct to use? That is why the study of time series is so relevant, along with all of these volatility models. So something to keep in mind is which one is more correct might change at different times. So this is going to be the moving target, right? There's no set and forget in a volatility trading setting. There's no such thing as a set and forget. Things dynamically change on a daily basis all the time. So one measure might be more correct than another during any given time period. Something to understand and something to consider. Up until this point, we've been looking at realized volatility. What that means is we're looking at this price path and a series of returns associated with this price path, and we're measuring the quadratic variation of this return series. That is the realized volatility, There's also a measure of implied volatility, and this is directly related to an option contract. So what implied volatility is it takes some sort of pricing function. Usually, unless stated otherwise, it is going to be a Black-Scholes pricing model. Nevertheless, you can also develop this notion of implied volatilities with any other pricing function that takes volatility as an input. So just want to leave that there as a disclaimer. There are such things as like Heston implied volatilities, for example. Not everything is just a Black-Scholes implied volatility. But nevertheless, implied volatility, what it does is it takes the pricing model along with all of the assumptions, and it takes the market price of an option, which is determined by supply and demand, and it says, hey, what volatility input to this model gives us the market price? That's all volatility is. Essentially, it tells us the volatility that traders are pricing current options in the market at. So I take whatever volatility, whatever that implied volatility number is, based on the current market supply and demand, I put it into this pricing function, and it'll spit out the market price that I'm seeing anyway. So this problem of pricing options seems a little redundant if the market's going to determine the price anyway, right? Why do we care so much? Well, really, the important number is that implied volatility, right? That makes everything apples to apples, if you will. We can see what the uncertainty measure is in terms of market prices right now in a forward-looking setting. That's this sort of very impressive, important aspect of these pricing functions. Why is this even more important and impressive? Well, the implied volatility itself is directly observable. I can observe the implied volatility right now. I can pull up a path of the implied volatility over time. So implied volatility is very different from realized volatility. Implied volatility is directly related to the option price. In fact, you can usually swap them out on some sort of volatility surface visualization. I'm sure I'm going to do another video on the volatility surface in the near future, probably in terms of some sort of model calibration for price extrapolation. But regardless, these are two separate quantities. It's very important to distinguish them, because here in these examples, and the simplified example and the more complex examples, even this example using two different models for volatility, we're looking at realized volatility. We're not looking at the option implied volatility. It's very important to discern these two quantities. Here I outline, the methodology of deriving implied volatility, what it tells us. And it's also very important to know that you can come up with different types of implied volatilities. But remember, unless stated otherwise, it's going to be in terms of a Black-Scholes implied volatility. Things get a little tricky because there's this notion of implied volatility and realized volatility. Sometimes people say realized volatility is historic volatility. However, there's also a notion of historic implied volatility. Wow, that's a lot. What do I mean by this? Well, in all of these examples above, we've looked at historic realized volatility. We're looking at volatility in a backward setting, historic, and we're looking at the realized volatility. We're looking at quadratic variation of the return series. That's the historic realized volatility. And I've simulated another example of this. This is just the true volatility path relative to the 30-day rolling quadratic variation. But we can also look at the historic implied volatility. What do I mean by this? Well, if we do that process of taking some sort of pricing function, determining the volatility to put into that pricing function that spits out the current market prices, we can just lock in that value, record it at a certain point in time, and do that on a daily basis. Then we have a series of implied volatilities, and in a backwards looking setting, that's historic implied volatility. So very important to understand these ideas. This is the true path of implied volatilities. It's very important to understand this. Of course, it's going to depend on how you aggregate it. Are you looking at one option? Are you looking at all the? Yes, there's a lot that goes into this quantity here, but it's observable. We don't have to do any sort of filtering or anything like that. This could be some sort of aggregate measure across at the money options, whatever it may be. You can observe this quantity of implied volatility. This is the true historic implied volatility path that we're looking at. In fact, this is for Nvidia. I've queried the data, and I've also included a script if you would like to query the data yourself, but I've also included the data in this repository with the Jupyter Notebook. Which volatility measure is then correct? We know they're inherently different. We know that the models that we're imposing are inherently wrong. Nevertheless, do they track a similar level? Are they useful in the sense that we're coming up with some sort of actual measure for volatility? Let's take a look. What I've done is I've queried this information for Nvidia from 2020 to 2025. We're looking at the implied volatility. We're looking at a proprietary measure of realized volatility. And we're going to simply look at the quadratic variation, just as we had done in the simple examples above with a constant volatility and a mean reverting volatility in that Heston sense. So here, I've visualized each of these over time, and you can see that they track relatively well some level of volatility. What I mean is, implied volatility isn't out here at 120% with realized volatility down here at 20%, right? That's not at all what's happening. These are tracking some sort of level in a reasonable sense. Now, that level will change over time, right? Just because it's about 40% here and it's about 60% here and it comes back down to 40% here does not mean that it's going to always revert down to this mean 40%. And that's a very important idea. This mean level is going to change over time. Right? The only certainty in this trading space is that your assumptions are wrong and things are going to change over time. That's trading. That is why it's a full-time job to develop and deploy these models, because it's not a set and forget print money. You have to understand that these dynamics change over time. And it's very easy to see that in something like this time series of volatilities. Okay, so which one's correct? Well, obviously they measure different things, but they track a level relatively well with respect to one another. If we're trying to do some sort of feature engineering, I figured I would sprinkle this idea in. If we're taking a look at all of these measures of volatility, what can we do to develop an aggregate measure? An aggregate measure. I've had a video in the past on principal component analysis. It's a deep dive into PCA in the context of the return space, so I highly encourage you check that out. But one thing we can do is we can develop a whole bunch of different measures for volatility. Maybe we're looking at realized volatility measures, different implied volatility measures. Maybe we're using different pricing models. We're looking at implied volatilities across different pricing models. We're looking at different ways to filter and smooth realized volatility, and we have maybe 30 measures of volatility. Here I only have 3. But what we can do is we can conduct a principal component analysis to try to determine if there's a way to combine all of those volatility features in some linear way to essentially reduce the dimensionality. And that's exactly what I've done here. So what I've done is I've taken this series of different volatility features, and I said, hey, I want to compress this into, say, 1 or maybe 2 features. I could have 30 different measures of volatility, but what I've done is I've done this PCA on these 3 measures, and you can see that within the first 2 principal components, I capture roughly 97% of the variation in that space. So using only 2 features, I capture 97% of the variation in this series. That is quite an impressive number, but it's not at all unexpected, right? If you had more volatility features, you could probably compress it down to maybe 3 or 5, whatever it is, and you could capture a significant amount of variation within that volatility space. You could also take a look at the loadings on each of the implied and realized volatilities to see which one contributes to more on each of the principal components in the PC space. But again, this is going to be more related to the idea of dimensionality reduction and principal component analysis, specifically for feature engineering of volatility feature. If you're doing some sort of machine learning model for trading, I'm going to create a separate series on this, but I certainly wanted to include it because in the context of volatility, which one is correct is a very reasonable question to ask. And we know that the implied volatility is inherently different from realized volatility. So if we have all of these different measures, is there anything that we can do to combine them into one sort of powerful signal? And there certainly is. You could do some sort of PCA like this, and then you would just ensure that the loadings are relatively stable over time to be able to use that feature. And of course, that's the game, right? If these loadings change next month, then that feature is going to be entirely different, right? The feature capturing, say, 97% of the variance, if all of these loadings are different next month, it's a completely different feature. So it's just important to keep that in mind. In terms of compressing all of these volatility features, figured I'd sprinkle this in. It's certainly something that is very useful, especially in a machine learning setting. We can now start to discuss trading volatility. We have these different measures of volatility. We know how implied volatility is calculated. The only thing that we really need to understand now is how that implied volatility impacts price, and then come up with some sort of statistical model to justify our trades. So we know that anytime uncertainty increases, volatility increases, and prices are higher, right? Doesn't that make sense? If you had some contract or insurance, then if uncertainty is higher, is that contract going to be cheaper? No way, right? That contract's going to be more expensive. The person who's issuing that insurance for you is going to be like, whoa, I don't know what's going to happen even more now, so you have to pay me more in terms of premium. That just makes sense, right? So in terms of volatility, what we're trying to do is we're trying to figure out, okay, if option prices tend to be higher when implied volatility is higher, and lower when implied volatility is lower, is there any sort of statistical model that we can come up with to trade that idea? Of course, that's assuming all else is equal. We're not looking at time decay. We're not looking at trend. We're not looking at anything else. We're just looking at this idea of volatility. This is a lecture on how to trade option implied volatility, and that's all we're looking at. Let's come up with some sort of statistical model to trade this. What I've done here is I've plotted two implied volatility paths. The first one here is going to be the implied volatility paired with the following 30-day average implied volatility. What you'll see is this red line is the regression line. The black dotted line is y equals x. So if the implied volatility was correct, we would see all of these blue dots along this black line. Clearly, this is not the case. Moreover, here, this is a high volatility period regime. This effect is more pronounced. You can see this slope is more shallow in this second chart. So this is going to be the implied volatility relative to the forward 30-day average volatility in terms of implied volatility, not realized volatility. And you can see that what happens here is there's an intersection between y equals x and this regression line. So what that means is here, anytime you are to the left of this intersection, a lower vol tends to map, a lower implied vol now tends to map to a higher average implied vol later. But the flip side is true on the other side of the line. This is a very, very interesting dynamic. So what we're observing here is, wow, when volatility or implied volatility is lower, again, everything's relative, when it's lower, the forward average implied volatility tends to be higher. Moreover, when the current implied volatility is higher, the forward average implied volatility is lower. Doesn't that sound like some sort of statistical arbitrage? Well, maybe it is. Maybe we can sell options when they're overvalued and vol is higher. Then when vol tracks lower, we cover that position and buy it cheaper, collect that difference. Same thing here. We buy it when vol is lower and sell it when it's higher. So this intersection is essentially telling us when we should go long or short an option. And then at some point in the future, if the value doesn't get eaten by theta, or if trend doesn't kill us and all this other stuff, perhaps we can collect that difference. And this effect is even more pronounced in a high vol period setting, hence the shallower regression line. So this is in fact a valid volatility trading strategy. Again, within any trading strategy, this model, of course, this model's wrong. There's going to be cases where you get absolutely killed. Volatility is going to spike after you sell that premium, or it's going to vanish as you buy that option. That will definitely happen for sure. However, on average, it does look like there is an opportunity to essentially buy low, sell high, buy low. And that justifies this trading strategy to some capacity. So this is how we might go about choosing to trade the option implied volatility on Nvidia. This is a quant trading strategy, an option trading strategy, whatever you want to call it. This is a valid, very simple way to begin to research and implement and develop this option trading strategy. Let's focus only on this idea of high volatility, right? We've noticed that volatility tends to be mean reverting. What do I mean by that? If we go back up to this volatility series, we know that vol isn't going to continue to increase like a price series. It's inherently different, right? What happens here is this volatility is going to continue to go up and down in times of uncertainty and less uncertainty and more uncertainty. And it's important to understand this because in the context of vol being high, it's not going to stay high forever. Moreover, in the context of vol being low, it's not going to stay low forever, right? If it gets too low, any news that comes out is going to spike vol. If it gets too high, then eventually prices are going to be too high and it's going to normalize and drop back down when uncertainty is actualized and everyone says, oh, well, we kind of panicked and set prices too high. And that is kind of the economic interpretation of this strategy. So it's important that anytime you come up with some sort of statistical model, you're not just trading it blindly, but there is economic intuition into why this would be the case, right? Why we might be able to sell options when they're overvalued and buy options when they're undervalued, because this dynamic for implied volatility economically makes sense. In terms of high uncertainty, right? We're going to jack prices up because we're afraid. Boom, sell them when prices are high. Then when the real path of implied volatility is actualized, we can buy back and cover that position and collect that difference. Same thing when vol is too low. When vol is too low, anything can rock the boat, right? If you're on a glass lake and you're on a canoe, there's a gust of wind, that's going to rock the boat and it's going to create all these ripples. Vol's going to increase. You could buy low and you can sell high. So here we're just going to look at this high volatility period, and it's kind of deceptive, right? This is a very productive chart, I will say, because of this y equals x line. But if we just take the forward difference and we look at the difference between the volatility at spot and then the forward realized implied volatility, the effect is far more pronounced, right? We can see that, wow, at somewhere around 0.64, and in fact I solved for it here at 64%, volatility tends to decrease over the next 30 days. So anything above 64.2575%, we tend to see the average implied volatility over the next 30 days decrease. What does that mean? Well, that means we can buy high or we can sell high, buy low. So we're essentially collecting that difference. And this chart hopefully makes it more concrete, whereas this chart shows the dynamic on both the long and short side. This will show the dynamic on simply just that sell high, buy low side. So anything above 64%, that's saying, hey, traders are valuing this option way too high for what is anticipated in terms of the realized volatility. Let's go ahead and sell it, and we can go ahead and buy it back when vol drops, and then we're going to collect that spread there. Now, it is important to understand that this is simply just looking at the math, right? This is a statistical basis for trading. It says nothing of the actual dynamics of the market, right? If tariffs are rocking the heck out of the boat, and we haven't seen tariffs from an administration in quite a long time, maybe it's not a good idea to use this strategy. Maybe we should consider different shocks, maybe they're more idiosyncratic or industry-based shocks, that we're more confident will normalize in the next 30 days. Whereas something like tariffs rocks the heck out of the boat, we sell, and vol spikes, we get killed. Something to consider is it's not just about the statistical basis for these trades. What makes for it is also the economic interpretation. It's that, okay, we've seen the idiosyncratic boat rocked and vol normalize. We've seen the industry boat rock and vol normalize. We've seen the macro boat rock and vol normalize. But what is causing this spike in volatility? Is it going to normalize over the next 30 days, or are we going to have a prolonged effect that we need to be concerned about, and then we're not going to be able to collect that profit? So it's very important to understand not just the statistical basis for trading the strategy, but also the economic basis for trading the strategy. Based on the analysis above, I've developed a simple entry, execution, exit criteria for our trading strategy. I've simplified it significantly for this simulation, and what I've done is I've just used the historic implied volatility of Nvidia to essentially execute trades on this basis of, oh, when it's far too high, I think I use a vol of like 0.8, we're going to sell, and then eventually when vol comes down, we'll cover that position. And you can see this is what the equity curve looks like for such a strategy, and it's up and to the right. We're geniuses, we're rich. Yeah, I know. I understand the situation, right? We're not considering a lot of different facets of the market and prices. What I've done is I've fixed the other parameters of the pricing function to visualize this capture of vol being too high at one point in time, and then normalizing and then covering and collecting that P&L, right? You're subject to a lot of other factors. This P&L curve is subject to a lot of other factors. You're going to be subject to the dynamics of the underlying. You're going to be subject to whether vol actually normalizes, time decay. You're going to be subject to a lot of different factors impacting this overall equity curve. And that's what I've listed out here in terms of consideration. In any trading strategy, you're always going to have those other factors. It's never going to be a set and forget. This is one trading strategy. There are an innumerable number of trading strategies. And that's the whole point, is we understand the statistical basis for this trading strategy. We understand the economic basis, the economic interpretation of fear and pricing too high or maybe pricing too low. We understand the economic basis for it. we also need to understand the risks associated with achieving some sort of equity curve that looks like this, and I've listed those out here. That being said, this is certainly a place to start. If you can't make money in a simplified world, how on earth are you going to make money in the real world? So what we've done here is actually extremely productive. This is something that you would do at some sort of trading firm. You start with a simplified base case state of the world. You say, okay, I have this hypothesis. You go about collecting your data. You have some sort of simple model. You increase the complexity of the model. You get your real world data. You visualize an effect of something like this, and you say, wow, I noticed that at some points, vol is statistically way too high or way too low. Something's going to rock the boat in either direction. I can collect money on the upside or the downside depending on the long or short position I take and where vol is and where it will be. And what I'm going to do is I'm going to simulate and backtest that strategy and see what happens. See how I can hedge away my risk factors, see what happens if there's any actual profit to be had, if maybe my transaction costs eat away at it, maybe all these other factors kind of destroy the profitability of the strategy. But if it doesn't, then you keep going, or maybe it does and you continue to optimize and you get to a place where you do have an equity curve that looks like this. But overwhelmingly, that's the space. The space is dynamic. It changes over time. You're never going to have a set and forget. So when I say this is a video on how to trade option implied volatility, it certainly is a video on how to trade option implied volatility. I'm giving it to you completely straight. I'm saying, hey, you can go about measuring volatility in these different ways. There's realized measures of volatility. There's implied measures of volatility. We can come up with some sort of statistical basis for what happens to maybe say implied volatility and its impact on an option's price. We can come up with some sort of way to profit on that statistical tendency. We also have some sort of economic interpretation for that statistical tendency, which is solid gold. Otherwise, you're kind of just shooting in the dark, finding some sort of correlation and hoping that it actually sticks. If you have an economic interpretation, it tends to be very important, very useful. That's how you can ensure stability over some course of time or over some different regimes. And then, of course, comes the back testing, looking at simplified states where you have fixed parameters, looking at dynamic states where you're using actual data. And then that's where you optimize your strategy and tinker with it until you have a reasonable strategy that you can deploy. Lastly, in terms of this strategy, some considerations, right? We're selling when the option is overvalued. We're buying it when vol normalizes, when it's at a lower value. What could kill our profit? Time decay, some sort of volatility contraction issue. Vol could just keep going higher. Like I said, maybe the uncertainty that rocks the boat is so much uncertainty that it's not going to normalize within a reasonable time and we're going to get killed. Maybe we have gap risk, margin requirements, correlation risks. These are all facets of risk that might impact the overall equity curve, this beautiful up and to the right equity curve. So with that, I want to thank you so much for watching. I hope you enjoyed the video. I hope you learned something, and I will see you in the next one.